First of all, your reaction to the Fed. Let me just start with the Fed before we talk about CPI and the fact that they have upgraded or revised their dot plot projections to only one rate cut expectation for this year.
Yeah, very interesting. But to be honest, I think it was tough for them with regards to the fact that the data they were making these decisions on was arguably a little bit stale. The CPI print came out that suggested, a softening in the numbers. We've been calling for, slow disinflation trend to continue, and arguably the voters didn't have all that information when they made this. This is going to, create volatility, but does it really change the trajectory? We still think that the Fed will cut rates. We think 2 this year. We think we're going to have, as I said, some volatility that will affect bonds, but generally speaking, treasuries will rally for the year because of that. And also 1 or 2 rate cuts, is that materially going to affect the strong trend we're seeing in equities? Probably not. So whilst it's going to create short-term volatility, the longer-term trend, we don't think it was a big impact this meeting.
Yeah, I mean, I've had this conversation with many people over the course of the last few months, and the question that people are asking is not just necessarily when are the Fed going to start cutting interest rates, but how much will they cut once they start the cycle. I thought yesterday was also interesting that they have actually revised upwards the number of cuts they're expecting for 2025. How seriously should we take that, and how is that likely to affect where assets trade?
Well, I think it's a really good point. Trying to understand how much they're going to cut is going to be the long-term question. Now, if you actually look at the forecasts of the back end of the curve and you see how accurate they've been, it's not that great. They tend to move around as the market plays out over the months. So for us, we do have to keep an eye on how many cuts. We do have 2 for this year and more likely double that for 2025. So that's going to be a material amount. We must also remember how much spacing they're going to have between. If there's larger spacing in between, then the market has time to digest. It's not going to be such a big impact, and that's going to be dictated by the strength of the U.S. economy. And at the moment, and seen by stock markets, the consumer remains robust. The GDP forecast, we're actually revising upwards. So we think that the markets, the Fed is looking to slowly calm down the pace of the market, nothing too aggressive. And it really is a patience game. We have to be patient as investors in this environment.
Yeah, yesterday, as we headed into such a big day for U.S. markets, the question that I had is which was going to be more important for investors, that CPI print or Fed? And I think we can safely say, looking back, it was the CPI that served to be the major catalyst for these markets yesterday, namely for U.S. Treasury. We saw a massive rally. And I do wonder whether looking ahead, we should be placing more emphasis on these inflation numbers and less really on the Fed's own projections of what they're going to do. Because, as you say, there have been a lot of question marks about whether or not they're going to stick to these forecasts.
I think you're 100% right. Inflation is really up in front. Inflation and labour markets, right? We believe the labour markets, the strength of the labour markets, will dictate how long they remain at the current levels, and inflation will dictate the change. So the current inflation numbers suggest that we're going to see a change. The strong labour markets suggest it may take a while to see this change. So this is playing out in that environment, but we are nearing the peaks of yields, where we're seeing big central banks already turning. The ECB, the BOC, the Fed will cut rates, we believe, this year, and that is a shift. And a lot of money is then going to be shifting around. We shouldn't forget that there's been a lot of money put in deposits in the front end of the curve, sitting there being paid to be patient. That money is now going to have to move if we think those rates are going to come off. And where that money moves is going to be the next catalyst of change for the markets.
Yeah. Gareth, S&P yet through another record high, through 5,400. What could derail the momentum here?
Well, I think for the S&P, if we do see the consumer change, which is not a base case for us, if we do see another alternative for the S&P growth story, which we are seeing some in Japan and India, but still the scale is too big in the US. So to me, the underlying would be a loss of trust in the overall system, and that could come down to geopolitics. That could be one of the drivers if we're looking for something that could disrupt this momentum. Otherwise, we think it still remains robust. In the short to medium term, the drivers are still strong. As you said, the money coming out of deposits are going to look for an income play. There is a fear of missing out. Some will still follow the equity. Some will go into bonds out of cash. But there is going to be a rotation out of deposits as rates start moving into more risky assets, be those bonds or equities.